PepsiCo just reported its latest results, and on the surface, they looked strong. In Q2 2026, revenue reached $24.2 billion, up 6.4% year over year, while net income came in at $3.0 billion, up 138%. And yet, despite those results, the stock is still down about 4% year to date and around 8% over the last 5 years. So the big question is PepsiCo's recent decline justified, or is the market being too pessimistic? And more importantly, is the stock attractive today, or are investors buying into a business with limited upside? In this Simon Says video, I'll break down PepsiCo's business quality and financials, its forward outlook and growth estimates, and lastly, its valuation to estimate its owner's earnings and determine a possible fair value of the stock. Before we start, here's an important disclosure. This video is produced by Simon Says Formula. I am a private investor, not a financial advisor, and this video is for general information and educational purposes only. Because this video discusses a specific stock and includes valuation estimates, it may be considered an investment recommendation under EU rules. However, it is not personal investment advice and is not tailored to your financial situation. At the time of this analysis and publication, I hold no position in PepsiCo. I do, however, have indirect exposure through broad index funds. My position may change after publication. You can find the full disclaimer and methodology in the video description. Let's start with the business model and how this company makes money. While most people just know PepsiCo for Pepsi, the company is actually a much broader food and beverage business with brands like Mountain Dew, Gatorade, Lay's, Doritos, Quaker, and many more. They split their revenue into 3 broad buckets. First, Beverages North America. This includes brands like Pepsi, Mountain Dew, Gatorade, and other hydration and soft drink products sold across the US and Canada. Second, Foods North America. This is the convenient foods business, mainly built around Frito-Lay and Quaker, with brands like Lay's, Doritos, Cheetos, and Quaker Foods. And third, international markets. This includes PepsiCo's food and beverage operations across Latin America, Europe, Africa, the Middle East, and Asia. So overall, PepsiCo makes money through a diversified mix of snacks and beverages, with strong brands across both North America and international markets. That is why I rate the business model as positive. Now, on the revenue side, Q2 2026 was decent. Revenue reached $24.2 billion, up 6.4% year over year. On a trailing 12-month basis, revenue reached $96.9 billion, which was up 5.6%. Looking at the longer-term trend, PepsiCo's revenue has compounded at about 2.4% over the last 3 years and 4.5% over the last 10 years, with total revenue growth of roughly 56% over the past decade. So while revenue is still moving in the right direction, growth has been fairly modest, and in some years it has barely been much better than inflation. That makes the business look stable but not especially dynamic from a top-line growth perspective. That is why I would rate PepsiCo's revenue development as neutral. Next, let's look at PepsiCo's operating income and net income. On the operating income side, Q2 2026 came in at $4 billion, up 10.2% year over year. On a trailing 12-month basis, operating income reached $14.5 billion, up 17.3%, while the operating margin stood at 15%. Net income was more volatile but still looked strong on the surface. In Q2 2026, net income came in at $3 billion, up 138% year over year. Now that increase looks unusually high, partly because Q2 2025 included large impairment charges related to the Rockstar and B and Cheery brands. So the comparison base was unusually low, which makes the year-over-year jump look much bigger than the underlying business trend really was. It is probably more accurate to look at PepsiCo's core EPS growth, which was only around 4%, and that gives a much more normal picture of the actual business performance. On a trailing 12-month basis, net income reached $10.5 billion, up 38.9%, with a net income margin of 10.8%. Looking at the longer-term picture, both operating income and net income have grown over time, although the path has not been perfectly smooth. Over the last 3 years, operating income compounded at about 11.5% per year, while net income compounded at about 9.9%. And over the last 10 years, both metrics have also grown at a decent pace. So overall, I would rate PepsiCo's operating income and net income development as positive, although I was close to giving it a neutral rating because net income has been inconsistent over the years and profit growth has clearly been slowing down. Next, let's look at PepsiCo's cash flow. Operating cash flow in Q2 2026 came in at $2.3 billion, up about 18% year over year. On a trailing 12-month basis, operating cash flow reached $13.5 billion, up 10.4%, with an operating cash flow margin of 13.9%. Free cash flow also improved, reaching $1.5 billion in the quarter and $9.3 billion over the trailing 12 months, which gives PepsiCo a free cash flow margin of 9.6%. But the key issue here is that PepsiCo is not an asset-light business. Capital expenditures came in at $0.8 billion in the quarter and $4.2 billion over the trailing 12 months, equal to about 4.3% of sales. So while the company still generates solid cash, a meaningful part of that cash has to be reinvested back into the business. A few key takeaways from the cash flow statement stand out. First, cash generation has been a bit inconsistent over the last several years. Second, PepsiCo is a moderately capital-intensive company with CapEx often exceeding depreciations. Third, net income is clearly higher than free cash flow, mainly because PepsiCo has relatively high capital spending. And fourth, the capital allocation story is a bit mixed. PepsiCo continues to buy back stock and pay large dividends, and it has now increased its dividend for 54 straight years. But dividends are now getting close to $8 billion a year, which is almost as much as the company's annual free cash flow. So when a company is paying out that much cash while also carrying meaningful debt, I think that deserves some caution. I normally advise against companies taking on billions of debt while paying large dividends, unless they are also delivering strong growth, and that is clearly not the case for PepsiCo. That is why I rate PepsiCo's cash flow development as neutral. Now let's look at PepsiCo's balance sheet. At the end of Q2 2026, PepsiCo had $10.7 billion in cash and short-term investments, compared with total debt of $53.2 billion. That leaves the company with net debt of roughly $42.5 billion. To judge whether that is manageable, I compare it with operating income. Using trailing 12-month operating income of $14.5 billion, the net debt to operating income ratio comes out to 2.93 times. That points to moderate financial risk. In other words, the balance sheet is not weak, but it is also not especially conservative. And when you look at the long-term trend, PepsiCo has consistently operated with much more debt than cash. So overall, I would rate PepsiCo's balance sheet as neutral. Next, let's look at return on invested capital, or ROIC, which is one of the best ways to judge how efficiently a company turns capital into profits. Invested capital tells us how much money is actually tied up in running the business. In this case, I calculate invested capital as total equity plus total debt minus estimated excess cash. For PepsiCo in Q2 2026, that comes out to about $67.7 billion. Next, I want to calculate the return on invested capital, which measures how well the company uses the capital tied up in its business to generate profits. To do that, I calculate NOPAT, which stands for net operating profit after tax. I take operating income and multiply it by 1 minus the tax rate. Using trailing 12-month operating income of $14.5 billion and an after-tax factor of 79.9%, NOPAT comes out to about $11.6 billion. If we divide 11.6 billion by 67.7 billion, PepsiCo's trailing 12-month ROIC comes out to roughly 17.1%. Looking at the longer-term trend, ROIC has stayed fairly solid over time, mostly in the mid to high teens, which suggests PepsiCo is still a reasonably efficient business, despite its slower growth and higher capital intensity. So overall, I would rate PepsiCo's return on invested capital as positive. PepsiCo's strategy going forward is really about defending the core business while improving execution. First, management is trying to stabilize North America. That means improving value, product assortment, and overall execution in both snacks and beverages, especially at a time when US demand remains under pressure. PepsiCo also said that North American food sales were weak in 2026 and that it used price cuts on some snack products to try to regain market share. Second, the company wants to drive international growth. That is important because international markets are currently performing better than North America and are helping offset some of the weaker US trends. And third, PepsiCo is focusing on innovation and productivity. That includes launching healthier and newer products while also trying to improve efficiency and protect margins. Management is still guiding for organic revenue growth of 2% to 4% in 2026, along with 4% to 6% core constant currency EPS growth. But of course, there are also clear risks. The first is consumer pressure. Tighter household budgets are weighing on North American demand, especially in foods. The second is cost inflation. Higher commodity, packaging, fuel, and logistics costs could continue to pressure margins in the second half of 2026. And the third is health and category pressure. Processed food concerns and the shift toward healthier options could slow volume growth in some of PepsiCo's core categories. So overall, I would rate PepsiCo's strategy and risk outlook as neutral. There are still strengths in the business, especially internationally, but near-term pressure in North America and margin risk make the outlook more balanced than exciting. Next, let's look at PepsiCo's revenue and EPS estimates. Starting with revenue, analysts expect PepsiCo to grow by about 5.4% in 2026, followed by 2.9% in 27, 3.3% in 28, and just 0.9% in 29. So the main takeaway here is that revenue is still expected to move higher, but the growth outlook is fairly modest and slows down quite a bit after 26. On the earnings side, EPS is expected to grow by around 5.0% in 26, 4.8% in 27, 5.7% in 28, and 1.2% in 29. That is a bit better than the revenue outlook, but still not especially impressive for a company trading at a premium consumer staples multiple. So while the estimates are still positive, they do not point to a particularly strong growth story. In some of these years, growth is only slightly above inflation, which means real growth could be quite limited. That is why I would rate PepsiCo's revenue and EPS outlook as neutral. Next, let's translate those revenue estimates into one combined 3-year growth forecast. I start with PepsiCo's trailing 12-month revenue in Q2 26, which was $96.9 billion. Then I take the remaining growth expected in 26, add the full year estimates for 27 and 28, and include the partial growth expected into 29. When I compound those periods together, the result is an estimated 3-year growth rate of 9.13%. So PepsiCo is still expected to grow, but the pace is relatively modest, which is why I view the growth outlook as neutral. Now let's wrap it all up with the final scorecard. Starting with the business model, I rate PepsiCo as positive because it is still a diversified food and beverage platform with strong global brands. Revenue, however, gets a neutral rating. PepsiCo has grown revenue at a 10-year CAGR of 4.5%, which is stable but not especially strong. In some years, growth has only been slightly above inflation, so real growth has been fairly limited. Profitability is positive, with operating income growing at a decent pace and the operating margins still sit at around 15%. Cash flow is neutral because PepsiCo still generates solid cash, but free cash flow is held back by high capital spending and large dividend payments. The balance sheet is also neutral, with net debt at about 2.9 times operating income, which suggests moderate financial risk. Capital efficiency is positive because a 17.1% ROIC is still a solid result for a mature consumer staples company. Strategy and risk is neutral, mainly because consumer pressure and cost pressure are offsetting some of the strength in PepsiCo's global brands. The 3-year growth estimate is neutral too, with a compounded growth rate of about 9.1%, which is okay but not especially exciting. And finally, these scores feed into my required return. Because PepsiCo is a high-quality and stable business, but with modest revenue growth, moderate leverage, and some consumer and cost pressure, I require a 7% owner's earnings yield. In simple terms, that means I would want to buy the business at around 14.3 times owner's earnings on an enterprise value basis. So overall, PepsiCo still looks like a decent company, but the scorecard does not justify paying a very high multiple, but I do, however, realize that this is a very conservative required return for such a stable company. Now we move into the valuation part of the analysis, starting with owner's earnings, a concept popularized by Warren Buffett. The goal here is to estimate how much cash the business could realistically generate for owners after the normal reinvestment needed to maintain the business. For PepsiCo, I start with core operating income. Then I adjust that for taxes, add back depreciation and amortization, and subtract my estimate of maintenance capital expenditures. For maintenance CapEx, I use the lower of actual CapEx and depreciation and amortization adjusted upward by 10% as a margin of safety. In this case, CapEx is $4.2 billion and lower than depreciations, so I use that as my maintenance CapEx estimate. After putting those numbers together, my estimated owner's earnings for PepsiCo come out to about $11.9 billion. This is the number I will use as the foundation for the valuation, instead of relying only on reported net income or standard earnings multiples. Now that we have estimated owner's earnings, we can use that to calculate a baseline fair value. This is my zero growth valuation, meaning I am asking, what would PepsiCo be worth today if I gave the company no credit for future growth? I start with estimated owner's earnings of $11.9 billion. Then I apply an enterprise value to owner's earnings multiple of 14.3, which comes from my required return of 7%. That gives me an estimated enterprise value of about $170.3 billion. From there, I subtract total debt of $53.2 billion and add back total cash of $10.7 billion. That gives me an estimated equity value of $127.8 billion. Finally, I divide that by the number of shares outstanding, which is about 1.366 billion shares. That gives me an estimated fair share price of around $93.6 based on current owner's earnings. Now, to be clear, this is not a DCF model. It is a simple owner's earnings yield valuation based on what the business is earning today. Now let's look at the growth-adjusted valuation. In the previous slide, I estimated PepsiCo's fair value based only on current owner's earnings, with no credit for future growth. Now I want to ask a slightly different question. What could PepsiCo be worth in 3 years if it actually grows in line with my estimate? I start with owner's earnings of $11.9 billion and apply my estimated compounded 3-year growth rate of 9.13%. That gives me adjusted owner's earnings of about $13.0 billion. Then I apply the same enterprise value to owner's earnings, multiple of 14.3, which gives me an estimated enterprise value of $185.9 billion. From there, I subtract total debt of $53.2 billion and add back total cash of $10.7 billion. That gives me an estimated equity value of $143.4 billion. Finally, I divide that by 1.366 billion shares outstanding. That gives me an estimated 3-year growth-adjusted fair price of about $104.9 per share. I want to emphasize again, $104.9 is not today's fair value. This is where my fair value estimate could move over the next 36 months if PepsiCo hits the growth assumptions used in this model. So by mapping out both calculations, we now have a valuation runway. Now let's bring the valuation together and compare it with the current share price. As of July 10, 2026, PepsiCo was trading at around $137.4 per share. Based on current owner's earnings, my estimated fair price is only $93.6 per share. That implies roughly 31.9% downside from today's price. Even if I give PepsiCo credit for the estimated 3-year growth outlook, my growth-adjusted fair price only comes out to $104.9 per share. That still implies around 23.6% downside from today's price. Then I apply a 10% margin of safety. With that margin of safety, the current earnings fair price drops to $84.2, while the 3-year growth-adjusted fair price drops to $94.5. So under this model, PepsiCo would need to fall meaningfully before it becomes attractive. The key takeaway is that PepsiCo may still be a quality business, but at today's price, I do not see enough upside to justify buying the stock. Now let's put the valuation into perspective on the chart. At the current share price of around $137, PepsiCo is trading well above all of my estimated fair value ranges. My current earnings estimate gives me a fair value of about $93.6 per share, and with a 10% margin of safety, that falls to about $84.2. Even if I give PepsiCo credit for the expected 3-year growth, the fair value only rises to around $104.9 or $94.5 with a margin of safety. So under this owner's earnings model, PepsiCo still looks expensive at today's price. The way I see it, buying PepsiCo at these levels is almost more similar to buying a bond-like investment than buying a stock with strong upside. You are mostly paying for stability, brand quality, and a dependable dividend, not for high growth or large margin of safety. And when compared with US bonds, that matters. If PepsiCo only offers a modest earnings yield and limited growth, then investors need to ask whether they are being paid enough extra return for taking equity risk. For me, based on this model, the answer is a no. PepsiCo may be a quality business, but at the current price, the valuation does not look attractive enough. If you enjoyed this video, make sure to hit the like button, subscribe to the channel, and leave a comment below with your thoughts on PepsiCo as a business. Thank you so much for watching this Simon Says video, and I'll see you in the next analysis.